If you've ever made a mistake with money, you're not alone. If you've ever bought too high, sold too low, hesitated too long, or acted too fast, you're in the company of nearly every investor who's ever walked this road. The truth is, investing isn't about flawless decisions. It's about learning, adapting, and growing through every experience, especially the hard ones. This audiobook isn't about avoiding every misstep. It's about understanding them your own, and those made by others, so you can become wiser, more resilient, and more confident. Because mistakes, when acknowledged and examined, aren't failures. They're feedback. They're mirrors showing us where we need to slow down, sharpen our thinking, or strengthen our strategy. Too often people step away from investing not because they lack intelligence, but because they've never been taught how to interpret their setbacks. They think a wrong move means they're bad with money. But the truth is, everyone starts uncertain. What matters most isn't where you begin, but how willing you are to keep learning. This journey isn't about fear. It's about ownership. It's about stepping forward not with the need to be perfect, but with the commitment to become more prepared. You don't need to be a financial genius. You just need to listen, reflect, and lead yourself with intention. Because your money deserves that. And so do you. Let's begin. Chapter 1. Chasing Hype. The danger of emotion-driven investing. There's a moment every investor faces sooner or later, the moment of temptation. A hot stock is trending, a cryptocurrency is skyrocketing, a new sector is suddenly making millionaires overnight. Or so the headlines say. Social media is buzzing, your friends are talking, and something inside you whispers, "If I don't act now, I'll miss out." This is the siren call of hype. It promises quick wins, effortless wealth, and validation. But more often than not, it delivers confusion, loss, and regret. Chasing hype may feel exciting, but it's rarely smart. And when it comes to investing, excitement is not a strategy, it's a liability. Let's go back to 2021 for a moment. GameStop, AMC, Dogecoin. These names dominated the news for weeks. Young investors poured in, driven by online forums and viral memes. Some did make a lot of money if they timed it just right. But many more lost their savings when the hype died down, prices crashed, and reality set in. What was the lesson? Not that these investments were inherently bad, but that the decision-making behind them was often driven by emotion, not logic. FOMO, or the fear of missing out, is one of the most dangerous forces in personal finance. It short-circuits your judgment. It pushes you to act quickly instead of wisely. And most dangerously, it convinces you that everyone else knows something you don't. But here's the truth. Investing is not a race. It's not a popularity contest. It's not about being clever or lucky. It's about being consistent and clear. Take the story of Clara, a marketing consultant in her early 30s. She had just started investing seriously and was excited to build long-term wealth. But one day she overheard colleagues talking about a biotech stock that had doubled in a week. Curious, she looked it up, saw glowing reviews online, and decided to throw in half of her savings. It kept rising, until it didn't. Within 3 months, the company faced regulatory setbacks and the stock tumbled. Clara panicked and sold at a loss, feeling foolish, disheartened, and set back. What Clara didn't understand was that price is not the same as value. Popularity is not the same as quality. And movement is not the same as momentum. This mistake is more common than you'd think, not because people are careless, but because they're human. Hype targets our emotions, not our logic. It feeds on urgency, not understanding. That's why chasing trends feels urgent, because the window seems to be closing. But long-term wealth isn't built in a window. It's built through the seasons. To protect yourself from hype-driven investing, you first need a personal investment philosophy. That doesn't mean you have to be an expert or have all the answers. It simply means having a set of rules that guide how you invest, why you invest, and what success looks like for you. For example, do you value long-term stability over short-term gain? Are you investing for retirement in 30 years? Or for a down payment in 3? Do you prefer to invest in businesses you understand, or are you willing to study emerging technologies? When you're clear about your goals and values, it becomes easier to ignore what everyone else is doing. You stop looking over your shoulder and start looking forward. Let's consider another real-life example. James, a school teacher, with a passion for financial literacy. When Bitcoin was surging past $60,000, everyone around him was buying. He felt tempted too. But James had a rule: he never invested in anything he couldn't explain to his 12-year-old students. And he couldn't explain Bitcoin in simple terms yet. So he waited. Eventually, the price fell dramatically. James didn't miss out, he stayed true to himself. And later he did invest in crypto once he'd done his homework and understood the risk. This isn't about saying don't invest in trending assets. It's about not investing because they're trending. The why behind your decision is just as important as the what. So how do you resist hype in practical terms? One powerful method is to create a 24-hour or 48-hour pause rule. If you're tempted to jump into a new investment based on emotion, wait. Use that time to research the asset, understand its fundamentals, and revisit your goals. If it still fits your plan after the excitement fades, you can move forward with more confidence. Another helpful practice is writing down your investment thesis. Ask yourself, why am I investing in this? What would success look like? What would make me exit this investment? Doing this forces clarity. It separates impulse from intention. You can also build a support system. Talk to people who don't get caught up in trends. Follow financial educators who emphasize long-term thinking. Unsubscribe from noise. Surround yourself with calm minds. And remember, every investment comes with opportunity cost. When you chase one thing, you're saying no to something else, often without realizing it. If that biotech stock or meme coin doesn't work out, it's not just the money you lost, it's also the time and opportunity that could have been invested elsewhere. Let's return to Clara. After her loss, she didn't give up on investing. But she changed her approach. She started reading more. She created an investment journal. She committed to investing in businesses she understood and believed in. 3 years later, her portfolio grew steadily, not with excitement, but with purpose. And maybe that's the real takeaway. You don't need to be flashy to be financially free. You don't need to jump on every trend to get ahead. You just need to know yourself and protect yourself from making emotional decisions that sabotage your goals. Because hype will come and go. But your vision, that's yours to protect, yours to build, yours to own. But what makes hype so hard to resist isn't just the promise of big gains, it's the illusion of safety in numbers. When you see thousands of others buying the same stock, the same token, or the same trend-driven fund, it feels validated. All these people can't be wrong, your brain tells you. Maybe this is the one time it's actually going to work. This is a cognitive bias known as herd behavior. It's wired into us from a time when being part of the crowd was the safest place to be. But in the investing world, following the crowd often means arriving late to the party and cleaning up the mess after everyone else has left. Consider the case of Trevor, a software developer who heard about a new electric vehicle stock being hailed as the next Tesla. Influencers were hyping it. Reddit threads were exploding, and early buyers were already bragging about doubling their investment. Trevor didn't want to miss out. Without research, he poured in a chunk of his emergency savings. A few weeks later, the company missed earnings projections, and the stock crashed by 70%. Trevor wasn't just disappointed, he was financially shaken. Worse, he no longer trusted himself as an investor. That's the hidden cost of chasing hype. It erodes your self-trust. When an investment doesn't go your way, especially one based on emotion, it's easy to internalize the failure. You stop seeing it as a poor decision and start seeing yourself as bad with money. But you're not bad with money, you were just never taught how to protect your thinking from emotional pressure. Real investing is boring most of the time. It's reading financial statements. It's watching your money grow a few percentage points at a time. It's sitting still when others are running in circles. And it's knowing that slow and steady wins the race, not because it's catchy, but because it's true. Ironically, some of the most successful investors are the ones you never hear about. They're not the ones making flashy trades or chasing trends. They're the ones quietly buying reliable assets, sticking to their plans, and letting time do the heavy lifting. They understand something most people miss: consistency beats intensity. Every time. You might be thinking, but what if I do want to take advantage of something big? What if I see an opportunity that really does seem solid? Great question. That's where discipline and planning come into play. It's not that you can't take risks. It's that your risks should be calculated, not impulsive. Set aside a small portion of your portfolio, maybe 5%, for speculative plays. That way you can explore exciting opportunities without putting your entire financial future on the line. This approach gives you the freedom to participate without being consumed. It also reinforces a powerful identity shift from someone who reacts emotionally to market noise to someone who leads with intention. You're not just an investor. You're a builder. And builders don't rush to follow every signal. They lay foundations that last. So the next time you feel tempted by a hot trend, pause. Ask yourself, am I making this decision from a place of strength or from a place of fear? If it's fear of missing out, of falling behind, of looking uninformed, take a breath. Your financial future isn't a race. It's a relationship. One you build with patience, knowledge, and vision. Chasing hype might feel exciting in the moment, but the true thrill that comes from watching your money grow, not through chaos, but through clarity. Chapter 2. Timing the market. Why perfection is the enemy of progress. At some point, every investor has thought the same thing. If I could just time it right. Buy low, sell high. Get in before the rally. Get out before the crash. It sounds so simple in theory, but in reality, trying to time the market often does more harm than good. Why? Because perfect timing is a fantasy. Even the most seasoned professionals with access to advanced analytics, insider commentary, and decades of experience rarely get it consistently right. For the average investor, the odds of predicting exact market highs and lows are so low that they might as well be random. Yet the desire to wait for the perfect time keeps so many people stuck on the sidelines. They keep their money in cash, waiting for a dip. They hesitate to invest because a recession might happen. Or they pull out of the market entirely after a loss, vowing to come back when it's safe. But here's the truth. The market is never fully predictable, and there's never a perfect time. Waiting for perfect conditions means waiting forever. Let's look at the story of Darius, a young professional who inherited $25,000 from his grandfather. He wanted to invest, but every time he checked the market, something made him pause. One month, inflation was rising. Another month, interest rates were climbing. Then geopolitical tensions made headlines. So he kept waiting, telling himself he'd invest once things settled down. 3 years passed. The market had grown nearly 25% in that time, while his money sat idle in a checking account, earning next to nothing. The cost of not investing can be just as damaging as a bad investment. Inflation quietly erodes purchasing power. Opportunity cost silently builds up. And the longer you wait, the more ground you need to cover just to catch up. Now contrast Darius with Isabel, a nurse who also had $25,000 to invest. She knew she wasn't an expert, so instead of trying to guess the perfect moment, she committed to dollar-cost averaging, investing a fixed amount each month no matter what the market was doing. Some months she bought when prices were high. Other times she got shares at a discount. Over time, her average cost evened out, and her portfolio steadily grew. While others were paralyzed by uncertainty, Isabel kept moving forward with calm, consistent action. That's the difference. Darius waited for certainty. Isabel built momentum. There's a psychological trap at play here called loss aversion. Humans are wired to feel the pain of a loss more strongly than the pleasure of a gain. So we hesitate. We second-guess. We try to avoid doing anything that could lead to regret. Ironically, that hesitation often becomes the very cause of regret itself. Let's bring in some data. Studies have shown that missing just the 10 best days in the market over a 20-year period can drastically reduce your returns. And those best days? They often occur right after the worst days. That means if you panic and pull out during a downturn, you're likely to miss the sharpest rebounds too. Timing the market is not only hard, it can backfire. And yet the myth of perfect timing persists. It's appealing because it promises control. It whispers, if you're smart enough, if you're careful enough, you'll never lose. But investing isn't about never losing. It's about winning more than you lose, and letting time and discipline do the heavy lifting. Warren Buffett, one of the most successful investors in history, famously said, "The stock market is a device for transferring money from the impatient to the patient. It's not about predicting. It's about persisting." So what's the alternative to timing the market? It's trusting the process. That starts with understanding your time horizon. If you're investing for retirement, 20 or 30 years away, short-term dips should not scare you. They're part of the journey. If anything, they're opportunities to buy more at a discount. And if your time frame is shorter, say you're saving for a house in 5 years, then your strategy should reflect that too. Maybe you allocate more to conservative assets like bonds or high-yield savings. But even then, the goal is not to outsmart the market. It's to align your money with your goals and take action accordingly. Let's return to real life. Mia, a small business owner, used to panic every time the market dropped. She'd sell her investments, wait for things to feel safer, then re-enter later, usually at a higher price. She realized she wasn't investing with a plan, she was reacting. So she created a rule: she would only check her portfolio once a quarter. This small change gave her the emotional space to stick to her strategy, avoid knee-jerk decisions, and stay focused on the long game. You don't need to be brilliant to succeed as an investor. But you do need to be grounded. You need to understand that waiting for perfect timing often disguises fear and procrastination. And the longer you wait, the more you let fear take control of your financial destiny. So what can you do today? First, get clear on why you're investing. What is this money for? What's the timeline? What level of risk are you willing to tolerate? When you know the destination, you don't get distracted by every bump in the road. Second, automate your investments if you can. Set up monthly transfers into your chosen index fund, ETF, or diversified portfolio. Remove emotion from the process. Automation turns good intentions into real momentum. Third, track progress, not perfection. Your portfolio will fluctuate. That's not failure, it's normal. Instead of obsessing over daily returns, zoom out. Look at your performance year over year. Think in decades, not days. And finally, forgive yourself for not being perfect. No one gets it right all the time. But those who show up consistently with discipline and humility are the ones who win in the long run. Investing isn't about timing the market. It's about time in the market. The more time your money has to grow, the more you harness the power of compounding. And the more consistently you contribute, the more you build resilience against volatility. You don't need to be perfect. You need to be present. You need to start. You need to stay. And you need to believe that progress, however small, is better than perfection that never comes. Because when you stop chasing the impossible and start embracing the process, something incredible happens. You stop fearing the market and start becoming a real investor. There's another layer to this conversation about timing that deserves attention: what waiting really costs us emotionally. Because beyond the numbers and the data, there's a hidden psychological toll that comes from sitting on the sidelines too long. The longer you wait, the more you second-guess yourself. You replay the past. If only I had invested last year. If I had just bought during that dip. It becomes a loop of regret, hesitation, and comparison. And the longer that loop runs, the harder it becomes to break free from it. You don't feel smarter, you feel stuck. One of the biggest myths in investing is that more time leads to more clarity. But what it really leads to, if you're not careful, is more noise. You read more headlines. You watch more opinions clash on social media. You get overloaded with information but still feel unsure. In truth, clarity comes not from more time, but from more action. Small, consistent action. Take, for example, Ravi. He had been following the markets casually for years, reading blogs, watching videos, subscribing to financial newsletters. He felt informed but never confident. So he delayed. Every market movement looked like a warning signal. Then, on the advice of a friend, he invested a modest amount monthly into a diversified fund. After just 6 months of seeing his plan in motion, his anxiety began to fade. Not because the market had become less volatile, but because he had become more grounded through doing. That's the shift that changes everything. It's not about trying to predict the market, it's about participating in it. Because investing is experiential. You don't truly learn by watching from the outside. You learn by stepping in, adjusting as needed, and building emotional resilience through repetition. There's also a powerful identity shift that happens once you stop waiting. You go from being someone who watches others build wealth to someone actively building it yourself, from a bystander to a participant, from hesitant to intentional. So if you've been sitting on the fence telling yourself, maybe next month, maybe next year, let this be your turning point. Not because conditions are suddenly perfect, but because you've realized they never will be. And that's okay. Perfection isn't the goal. Momentum is. And here's one final truth. The people you admire for being financially secure or successful with investing, most of them didn't get there by making perfect decisions. They got there by making consistent ones. You don't need to outsmart the market. You just need to outlast your own doubts. Chapter 3. Ignoring risk. Overconfidence and the cost of blind spots. If the first mistake is letting emotion drive your investing, and the second is trying to time the market perfectly, then the third, perhaps the most dangerous, is underestimating risk. Risk is not just a buzzword financial advisors throw around. It's the silent force that can quietly unravel even the best-laid plans. And when it's ignored or misunderstood, it doesn't just cause financial losses, it creates blind spots. And blind spots don't just slow you down, they can wreck the whole vehicle. Let's start with a common misconception. Risk is not the same as volatility. Volatility is how much an asset's price moves up and down in a short period. Risk is about what you could lose permanently or for the long term, and how much that loss would affect your ability to reach your goals. Risk is deeply personal. It's not just numbers, it's about your life, your responsibilities, and your tolerance for uncertainty. Overconfidence blurs our view of risk, especially when markets are doing well. You've probably seen this happen. Someone starts investing during a bull market, sees quick gains, and suddenly thinks they've cracked the code. They double down. They go all in on a single stock. They start ignoring the basics, telling themselves, this time is different. But markets are humbling teachers. The moment you think you're invincible is often the moment you get hit the hardest. Take Jason, for example. In his late 20s, he got into investing during a booming tech cycle. He bought into high-flying growth stocks and watched his portfolio climb fast. He believed he had a talent, so he took out a loan, used margin, essentially borrowing money to invest and bet big. Then came a correction. A single earnings miss from his biggest holding triggered a sell-off. His leveraged position magnified the loss. Within weeks, he had lost nearly half his portfolio and was now in debt. Jason didn't fail because he invested in a bad company. He failed because he ignored risk. He overexposed himself. He forgot that preserving capital is just as important as growing it. One of the most effective ways to manage risk is through diversification, not just owning a bunch of different stocks, but owning the right mix of assets that respond differently to market conditions. Think stocks, bonds, cash, maybe some real estate, or even commodities depending on your strategy. It's not about chasing the highest return, it's about reducing the chance that one mistake takes everything down with it. Another blind spot is concentration risk when your portfolio is too heavily weighted in a single company sector or even region. For instance, many employees receive company stock as part of their compensation. It might feel like a vote of confidence to hold on to those shares. But if your paycheck, health insurance, and stock portfolio all depend on the same company, you're putting too many eggs in one basket. Then there's liquidity risk, the risk of not being able to access your money when you need it. Some people invest heavily in assets that are hard to sell quickly, like real estate or certain private investments, without having enough liquid cash or stable investments to cover emergencies. When life throws a curveball, they're forced to sell at the worst possible time, locking in losses they could have avoided. Risk is also present in how much you trust yourself. It's tempting to think that because you've read a few books or followed some experts online, you now have a sixth sense about the market. But real-life investing is a long game, not a one-time bet. The best investors are humble. They're not driven by ego, they're guided by caution and curiosity. Let's talk about sequence of returns risk, something few people think about. This refers to the order in which you experience gains or losses. It becomes especially dangerous for retirees or anyone drawing income from investments. If you start withdrawing from your portfolio during a market downturn, your losses can become locked in early and recovery becomes much harder. Planning for this means having a buffer, maybe in the form of a cash reserve or low volatility assets, so you're not forced to sell your growth assets at a discount. Even index investing, often seen as a safe strategy, carries risk. The market can be irrational for long periods. You can still lose money, especially in the short term. And if your expectations are unrealistic, if you expect 10% returns every year without fail, you're setting yourself up for disappointment. So how do you manage all these risks without becoming paralyzed? The first step is to acknowledge that risk is unavoidable. Every choice comes with trade-offs. Even doing nothing, keeping your money in cash, carries the risk of inflation eroding its value. The goal isn't to eliminate risk, but to understand and balance it. Second, know your risk tolerance emotionally and financially. If you panic every time the market dips, you may be overexposed to volatile assets. If you don't have a stable income or emergency savings, your investments should reflect that. Investing should fit into your life, not dominate it. Third, review regularly. What was appropriate 2 years ago may no longer serve you today. Your income goals or family situation may have changed. So should your portfolio. Risk management isn't a one-time event, it's a continuous practice. And finally, remember, this risk is not a reason to avoid investing. It's a reason to approach it thoughtfully. To build not just with ambition, but with wisdom. Let's end this chapter with a story that brings it all home. Sandra, a middle-aged school teacher, wasn't particularly aggressive with her investing. She wasn't chasing returns, but she was consistent, diversified, and careful. When a recession hit, her friends, who had gone all in on speculative growth stocks, panicked. They sold. She didn't. She had a balanced portfolio and a long-term view. When the market recovered, she was still standing stronger, wiser, and with more confidence than ever. Risk is part of the game. But risk is not the enemy. Ignorance is, and overconfidence is its silent partner. The most successful investors aren't the ones who take the biggest bets. They're the ones who protect their downside, know their limits, and walk the path with humility. Because wealth isn't just about how fast you build it, it's about how well you protect it. There's another kind of risk that rarely gets talked about, but it may be the most dangerous of all: the risk of complacency. It creeps in when things feel calm, when markets are steady, and when gains come easy. This is when many investors start to believe that the good times will keep rolling. They stop checking their asset allocation. They stop reviewing their strategy. They assume yesterday's results will repeat tomorrow. And slowly, without noticing, they drift out of alignment with reality. Complacency turns into overexposure. It's not that you suddenly become reckless, it's that you stop being intentional. Maybe you let a single stock take up 40% of your portfolio just because it's been doing well. Or maybe you stopped contributing to your emergency fund because your returns were so strong last year that it felt unnecessary. And then the unexpected happens. A recession, a job loss, a medical emergency. And just like that, the cracks in your foundation are exposed. The antidote to complacency isn't paranoia. It's awareness. It's cultivating a mindset of curiosity and reflection. Asking yourself regularly, what am I assuming or where am I too confident? That kind of honest questioning isn't weakness, it's strength. It's how great investors stay humble and adaptable. One way to protect yourself is by stress testing your portfolio. Ask yourself what happens if the market drops 20%. How would I feel? Would I need to pull money out? Would I lose sleep? What happens if interest rates spike or inflation runs hotter than expected? These aren't just hypothetical scenarios. They're tools to reveal your real comfort zone before it's too late. And don't forget, your risk tolerance isn't static. It evolves. A young single person just entering the workforce might have a very different appetite for risk compared to a parent saving for their child's college education or someone 5 years from retirement. That's why reviewing your investment plan at least once a year or after major life changes is so crucial. What served you yesterday may not serve you tomorrow. Lastly, let's talk about self-deception. Sometimes we know we're overextended. We feel it. That tightness in the chest when we check our brokerage account. That mental math we do to justify staying in a risky investment because we don't want to admit we were wrong. But investing isn't about being right all the time. It's about making fewer unforced errors and correcting them quickly when they happen. Risk will always be part of the equation. The goal isn't to avoid it. The goal is to respect it, to manage it, and to never let pride, comfort, or inertia keep you from making necessary changes. Because in the end, the market doesn't reward bravado, it rewards resilience. And resilience is built not on perfection, but on preparation. Chapter 4. Lack of clarity. Investing without a plan or purpose. There's a quote that says, "If you don't know where you're going, any road will take you there." And in the world of investing, this couldn't be more true. Many people enter the market full of energy and optimism, but without a clear plan. They invest because they feel they should, or because others are doing it, or because they want to grow their wealth. But they haven't defined what that wealth is for. They haven't mapped out what success looks like. And as a result, they drift. They react instead of build. And in time, confusion replaces confidence. This chapter is about the cost of investing without a plan or purpose. Not just the financial cost, but the mental and emotional toll it can take when your money doesn't feel like it's moving you towards something meaningful. Let's begin by stating the obvious: you don't need to have everything figured out to start investing. In fact, waiting for perfect clarity is another form of procrastination. But what you do need is direction, a rough destination, a reason for why you're doing what you're doing. Because without that, every market fluctuation becomes a crisis. Every new headline feels like a reason to pivot. You end up constantly reacting instead of steadily progressing. Consider Anna. She was in her early 30s, working a good job and saving diligently. She knew she should invest, so she opened a brokerage account and bought a few mutual funds. Then a co-worker told her about crypto, so she bought some. Then she read about real estate crowdfunding and jumped in. Soon she had assets in 5 different platforms, but no clear goal. Was she investing for retirement? A house, financial freedom? She didn't know. Her portfolio wasn't a strategy. It was a scrapbook of financial trends. And every time the market moved, so did her anxiety. What Anna lacked wasn't intelligence or discipline. What she lacked was clarity. She hadn't asked the deeper questions. What does financial success look like to me? What do I want my money to do for my life? What trade-offs am I willing to make to get there? Having a plan doesn't mean having a rigid checklist. It means creating a framework that helps you make decisions intentionally. For example, maybe your goal is to retire early or to have the option to work less in your 50s. That gives you a time horizon. It tells you how aggressive you might need to be or what kind of assets fit your timeline. Maybe your goal is to help your kids with college or to start a business. Those decisions shape how much risk you take, how liquid your investments need to be, and when you'll need access to your funds. Clarity gives context. It turns numbers on a screen into a story about your future. Without it, you fall into traps. like chasing performance, moving money around based on last year's winners, or panic selling when markets drop because you don't know what you were investing for in the first place, or over-diversifying into dozens of asset classes with no unifying strategy. You end up owning everything but building nothing. One of the most powerful things you can do as an investor is to define your why. Not just to make money, but what the money is for. Is it freedom, security, travel, generational wealth? The clearer you are, the easier it becomes to filter advice, ignore noise, and stick to your process. Another core issue that comes with lack of planning is misaligned expectations. People often expect their portfolio to grow in a straight line. They get discouraged by volatility because they haven't mentally prepared for it. But if your plan assumes ups and downs, if it builds in patience, then you don't panic when the inevitable happens. You expect turbulence, but stay the course because you know the destination. Clarity also prevents comparison. Without a plan, it's easy to measure your progress against others. You hear someone talk about their crypto gains or stock picks and suddenly you feel behind, even if your goals are completely different. But when you know what you're building toward, other people's wins don't distract you. You stop playing someone else's game. It's also important to remember that your plan should be flexible. Life isn't static. Neither is investing. Maybe you get married, have a child, switch careers, or decide to live abroad. These changes affect how you save, invest, and allocate risk. That's not failure, that's life. A good financial plan evolves with you. It bends but doesn't break. So how do you build clarity? Start simple. Begin with your values. What matters most to you? What does a good life look like? From there, identify your short, medium, and long-term goals. Then ask what kind of investments will help me reach each one. For example, if you want to buy a house in 5 years, your approach will differ from someone saving for retirement in 30. A shorter timeline means more focus on capital preservation. A longer one allows for more growth-oriented assets. It's not about right or wrong, it's about fit. And you don't have to do it all at once. You can build in phases. Maybe you focus first on establishing an emergency fund, then start investing for retirement. Later, you add a goal-based account for a future business or a child's education. Clarity isn't something you find overnight, it's something you build brick by brick. Let's end this chapter with a powerful reminder. Money without a mission is just noise. It moves around, but it doesn't move you forward. The purpose of investing isn't just to grow your bank balance, it's to support the life you want to live. Whether that's retiring with dignity, working on your own terms, or giving generously to causes you believe in. So if your investments feel scattered, if your portfolio feels like a collection of guesses, don't beat yourself up. Just pause, reflect. Ask yourself, where am I trying to go and how do I want to get there? Then realign, clarify, simplify. Because the moment your money begins to match your purpose, that's when everything changes. That's when investing becomes not just a financial act, but a deeply personal one. A tool of direction. A statement of intent. You don't need to have it all figured out. You just need to take the next step on purpose. Another reason clarity matters so much is because it helps you filter opportunities with discipline. The investing world is flooded with options: stocks, bonds, ETFs, crypto, real estate startups, precious metals, even art or collectibles. Without a guiding purpose, all of these can feel equally tempting or equally overwhelming. But when you know exactly what your money is supposed to do, it becomes easier to say no to what doesn't fit, even if it looks attractive on the surface. Think of your financial life like building a house. If you're not clear on whether you're constructing a tiny cabin or a multi-level home, you'll waste time and resources collecting materials you don't need. You might end up with too much lumber and not enough concrete. The same happens in investing. Without a design, without a blueprint, your financial life turns into a pile of fragmented assets, none of which really support the structure you're trying to build. Clarity also helps you face discomfort with courage. Many people avoid sitting down and making a plan because it forces them to confront realities they'd rather ignore, like not saving enough or being behind where they hope to be. But clarity doesn't mean perfection. It simply means you're choosing to see clearly rather than drift in denial. Even if what you see isn't ideal, it gives you a place to start. And starting from truth, even if it's uncomfortable, is always better than staying lost in ambiguity. Let's also acknowledge something important. Lack of clarity is often a symptom of financial noise. We live in a time where content is everywhere: blogs, podcasts, YouTube, TikTok. Everyone has an opinion, and many of them conflict. Without a framework of your own, you'll bounce from one voice to the next, chasing strategies that sound smart, but don't match your needs. And the more information you consume, the less confident you feel. That's why defining your financial purpose isn't just a planning tool, it's a filter for decision-making. It quiets the noise. It helps you say, "That's not for me," or "That doesn't serve my goals," and move on without guilt or fear of missing out. You stop being swayed by every hot take and start building your own compass. Because true wealth isn't just having money, it's knowing what to do with it and why. Lastly, having clarity opens up the opportunity for peace of mind. Investing becomes less emotional. You don't overreact to short-term dips because you're grounded in a long-term strategy. You don't obsess over beating the market because you've defined success by your own milestones, not someone else's scoreboard. You sleep better, make steadier decisions, and stay more consistent, all because you know what you're working toward. So if you're listening to this and realizing your investment plan is vague or maybe even non-existent, don't panic. That awareness is progress. Clarity begins with questions, not answers. Start with what matters most to you. Define it. Write it down. Then slowly, steadily shape your investing around it. Because once your money knows where to go, it finally starts taking you where you want to be. Chapter 5. Overreacting to the news media markets and mental health. Investing doesn't happen in a vacuum. It unfolds in a world that's loud, fast, and constantly updating. Every day brings new headlines, market surges, economic crashes, political unrest, viral trends, breaking news. And with each update comes a flood of commentary. Tweets, takes, debates, predictions. In this whirlwind of information, it's easy to feel like your portfolio is one headline away from disaster, or one opportunity away from a windfall. And that emotional seesaw is one of the most common causes of poor investing decisions. In this chapter, we'll explore the danger of overreacting to the news, how media influences our investing behavior, and how to stay grounded in your strategy even when the world feels chaotic. Let's start with this. Truth markets are noisy, and so is the media. That's not a criticism, it's an observation. The media exists to capture attention, and what captures attention? Urgency. Drama, conflict, fear, optimism that spikes, predictions that excite. But your financial life is not a 24-hour news cycle. It's a 20, 30, 40-year journey. And when you make long-term decisions based on short-term headlines, you distort the purpose of investing. Take a moment to remember March 2020. The world was shutting down. Markets were in free fall. News anchors spoke of recession, depression, unprecedented collapse. Many investors sold out of fear. They moved to cash, believing the worst was ahead. But what happened? Markets rebounded fast. In fact, many who stayed invested saw their portfolios recover within months. Those who panicked often missed the bounce, locking in losses and delaying recovery. That wasn't a one-time event. The same pattern repeated during the 2008 financial crisis, during COVID, even after geopolitical conflicts or inflation shocks. Media amplifies what's happening now, but investing rewards those who focus on what matters over time. There's nothing inherently wrong with staying informed. Being aware of economic shifts or market cycles is smart, but there's a difference between staying informed and being emotionally manipulated. If every news alert causes you to question your strategy or rush into a trade, you're no longer investing, you're reacting. Here's where we need to talk about something deeper. The emotional cost of constant exposure. Overreacting to news isn't just bad for your portfolio, it's bad for your peace of mind. It creates anxiety, decision fatigue, and a feeling that you're always behind. It makes you doubt your instincts, and worst of all, it erodes your trust in long-term planning. Let's look at a real story. David, a 42-year-old investor, had been investing steadily for years. He built a portfolio of index funds, contributed monthly, and avoided flashy trends. But during a year of volatile headlines, trade wars, interest rate hikes, and inflation scares, he began checking financial news multiple times a day. He started moving money in and out, reacting to every major headline. By year's end, his returns had fallen far behind the market. His decisions weren't based on fundamentals anymore. They were fueled by fear and noise. When asked why he shifted so drastically, he said something telling, "I didn't want to be the fool who saw the warning signs and did nothing." What David didn't realize was that his biggest mistake wasn't inaction, it was overreaction. That's the trap the media often sets. It convinces us that action equals control, that doing something is better than doing nothing. But in investing, sometimes the hardest and smartest thing to do is to stay the course. Now let's be clear. Not all media is bad. Some outlets provide valuable insights, thoughtful analysis, and context that helps investors understand the world better. The key is in how you engage. Are you using media to inform a thoughtful long-term process? Or are you letting it hijack your emotions and drive knee-jerk reactions? To avoid overreacting, build a buffer between information and action. That could mean setting rules like only checking your portfolio once a month, or choosing specific credible sources for financial news and ignoring the rest. It could mean waiting 24 hours before making any change to your investments in response to a headline. Give your logic time to catch up with your emotions. Another powerful tool is a written investment policy. This is a simple document where you outline your goals, your risk tolerance, your time horizon, and your strategy. When the news gets loud, read it again. Remind yourself what you're building and why. Anchor your decisions to principles, not panic. Overreacting also often comes from confusing volatility with loss. Just because your portfolio value goes down temporarily doesn't mean you've lost anything unless you sell. The media rarely emphasizes this. It focuses on daily gains and losses as if they're permanent. But smart investors understand volatility is the price of entry to long-term gains. The real risk is not short-term drops, it's being out of the market when it recovers. We also need to talk about mental health. The anxiety of always needing to know takes a toll. It creates a mindset of scarcity fear and hypervigilance. You start seeing every shift in the market as a threat, not a cycle. You lose the ability to zoom out. And over time, that stress wears you down. It's okay to step back, to tune out, to disconnect from the daily noise and trust the systems you've built. Investing is not about being perfect. It's about being consistent, resilient, grounded. That's not boring, that's powerful. So how do you protect your mental and financial clarity in a media-saturated world? First, remind yourself often news is not strategy. Just because something is urgent doesn't mean it's important. Just because it's popular doesn't mean it fits your plan. Second, check in with yourself regularly. If reading market news makes you anxious, consider changing your information diet. Your peace of mind matters more than staying on top of every fluctuation. And third, talk with people who invest with purpose. Whether it's a mentor, a financial advisor, or a friend who shares your values, surround yourself with steady voices. Investing is not just a numbers game, it's a mindset game. And your environment plays a huge role in shaping that mindset. Let's close this chapter with a truth that will serve you for life. The markets will always fluctuate. The headlines will always change. The noise will always rise and fall. But your financial future depends not on how much you know, but on how well you manage what you know. Your ability to stay calm, stay consistent, and stay committed in the face of chaos is what separates successful investors from anxious ones. You don't need to know everything. You just need to know what matters and build around it. Because your investment journey isn't a breaking news story, it's a legacy in progress, and legacies aren't built in a day. They're built in clarity and discipline, and in silence far from the noise. There's another layer to all this, and it has to do with identity. Over time, how we respond to news doesn't just affect our investment results, it starts to shape how we see ourselves as investors. If every market dip throws you into panic, you begin to identify with instability. If every headline sends you searching for a hot tip or dramatic exit, you start to believe you're not capable of sticking with a plan. That internal identity, one shaped by reactive habits, can quietly erode your confidence. And when confidence fades, so does consistency. The goal is not to become emotionless. You're human. You care about your money, your future, your family, that's good. But emotion needs to be guided, not eliminated. A great investor isn't cold or detached. They feel fear and excitement like anyone else. The difference is they've trained themselves to pause before they act, to check whether the trigger is real or just noise wrapped in urgency. This is where routines help. Simple habits like setting specific money check-in times weekly, not hourly, can reduce the emotional charge. Pair that with journaling your thoughts when market headlines make you anxious. Often just writing down your fears gives them less power. You begin to see patterns in your reactions, and those patterns help you understand your emotional triggers. It's also important to remember the most successful investors in history didn't get there by being glued to the news. They got there by having a philosophy. Warren Buffett famously avoids the noise. He buys businesses he understands, holds them for the long term, and pays far more attention to value than to volatility. And while he's one of the richest men in the world, his approach is surprisingly boring and deeply effective. There's a lesson in that. If you want peace, build an investment life that isn't dictated by headlines. If you want control, set your own pace. Don't let the rhythm of the media become the rhythm of your mind. Because what you feed your attention will shape your actions. And what shapes your actions eventually shapes your future. So as you reflect on your relationship with financial news, ask yourself, am I using this to make informed decisions, or am I just chasing the emotional high or low of being in the loop? Knowledge is power, but only when it's paired with perspective. And perspective doesn't come from more information, it comes from stepping back, seeing the big picture, and trusting that calm, clear, consistent effort will always outlast the chaos of the day. In the end, wealth isn't built by reacting quickly. It's built by responding wisely. Chapter 6. Doing it alone. The myth of the solo investor. There's a powerful myth that echoes through much of the investing world, the image of the lone genius. The person who stares at multiple monitors, calls the market with pinpoint precision, and builds an empire without anyone else's input. This myth is romantic. It appeals to our desire for independence, mastery, and self-reliance. But it's also misleading and potentially destructive. The truth is, investing is rarely a solo journey. Behind every great investor is a network of voices, lessons, mentors, advisors, peers, and even critics who help refine decisions and shape strategy. The myth of the solo investor sets unrealistic expectations. It says you have to know everything, do everything, and never make mistakes. That kind of pressure can lead not to better performance, but to burnout, bad decisions, and financial paralysis. Let's start with a simple truth: we all have blind spots. No matter how smart or capable you are, you can't see every angle. You can't predict every market shift. You can't stay objective in moments of stress or euphoria. That's where other people come in, not to control your decisions, but to challenge your assumptions and help you stay anchored. Take, for example, the experience of Emily, a smart-driven woman in her 30s who built a solid portfolio over the years. But when markets started dipping, she second-guessed everything. She spent hours in online forums bouncing between hot takes and doom predictions. Eventually, she reached out to a friend, someone with more investing experience, who simply asked her, What's your long-term plan, and has anything truly changed? That one question snapped Emily out of panic. She didn't need advice, she needed clarity. And that came through conversation. That's the power of community and connection. Sometimes it's not about finding the perfect answer. It's about not facing your questions alone. We often assume that asking for help shows weakness. But in investing, humility is strength. The willingness to learn to listen and to admit what you don't know sets you apart from those who believe they always have to be right. Financial markets are complex. They shift with technology, politics, psychology, demographics. No single person can keep up with it all. But together with trusted voices, shared insights, and honest conversations, we gain something more valuable than knowledge. We gain perspective. Let's talk about financial advisors. Many people assume advisors are only for the wealthy or for people who don't know how to manage money. But that's a narrow view. A good advisor doesn't take over your life, they help you make your life work better. They act as a second set of eyes. They ask smart questions, point out risks you might miss, and help you zoom out from the daily noise to see the bigger picture. Think of it this way, even Olympic athletes have coaches. Not because they're weak, but because even the best performers benefit from guidance, accountability, and strategy. If you're serious about building wealth, having someone in your corner isn't a luxury. It's a multiplier. Of course not, everyone needs a formal advisor. But everyone benefits from honest, informed conversation. Whether it's a friend, a mentor, an online community, or a study group, having others to share insights, explore ideas, and talk through fears makes you a stronger, more grounded investor. Even Warren Buffett, often seen as the ultimate solo investor, credits much of his success to his partnership with Charlie Munger. The two constantly challenged each other's thinking, refined each other's ideas, and avoided countless mistakes because they didn't work in isolation. This matters because investing is not just numbers, it's psychology. You need people who help you stay rational when fear clouds your judgment. People who remind you of your long-term plan when short-term pain tries to push you off course. And people who celebrate your wins not because they benefit, but because they understand how hard you worked for them. Now let's address the flip side. Who you listen to matters. Not all voices are helpful. In fact, some can be dangerous. The internet is full of self-proclaimed experts, influencers, and anonymous commentators who sound confident but offer shallow or biased advice. Be selective. Ask, does this person have a proven track record? Do they share the same values or goals as me? Are they selling me something or helping me grow? It's okay to tune people out. It's okay to build boundaries around your financial world. Community is important, but so is curation. You don't need a crowd. You need clarity. Let's take a moment to revisit your own journey. Have you been trying to do it all alone? Have you hesitated to ask questions, afraid it might make you look inexperienced? Have you avoided conversations about money because they felt vulnerable or uncomfortable? If so, you're not alone and you're not behind. But here's your invitation to shift that mindset. You don't have to be perfect to participate. You don't have to know everything to start learning. And you don't need anyone's permission to start building a circle of trust around your finances. Because here's what happens when you let go of the solo myth: you grow faster. You recover quicker. You make fewer emotional decisions. You build more resilience. And you start to see investing not just as a technical skill, but as a human one, rich with insight, conversation, and shared purpose. One of the smartest decisions you can make isn't just what to invest in, but who you invite on the journey with you. So find your people. Seek out those who challenge you respectfully, who support you without ego, who care about your success as much as their own. Whether it's one mentor, a small group, or a professional advisor, don't underestimate the power of relationship in financial growth. In the end, wealth isn't built in isolation. It's built in connection. And when you surround yourself with the right minds and the right hearts, you not only become a better investor, you become a better decision maker, a better steward, and a more confident architect of your future. You were never meant to do this alone, and now you don't have to. But perhaps one of the most underrated aspects of collaboration in investing isn't just about finding the right people, it's about becoming the right person within those circles. Being a strong investor in community means contributing as much as you consume. It's showing up with humility, but also with a willingness to share your own experience, even if it's filled with mistakes. Especially if it's filled with mistakes. Because nothing connects us more than financial vulnerability. The moment you open up about a loss you took, a fear you had, or a choice you regret, something powerful happens. You no longer feel isolated in your setbacks, and others no longer feel alone in theirs. That emotional honesty builds trust. And trust is the foundation of any meaningful growth, not just in investing but in life. This is where the greatest transformation happens, not just in your portfolio, but in your mindset. You shift from seeing investing as a competition to viewing it as a lifelong practice. You stop chasing the illusion of certainty and instead build systems that work with your temperament. You no longer get thrown off course by every new opinion because you've built your own core beliefs, refined by dialogue, not dictated by it. The truth is, connection doesn't make you dependent. It makes you resilient. When things go wrong, and at some point they always will, it's not just your knowledge that saves you. It's your network. When your strategy falters, when your emotions run high, when the market tests your patience, your ability to reach out, to lean on someone wiser or just someone willing to listen, can be the difference between giving up and staying in the game. And if you've never had that before, you can start now. Join a local investment club. Follow people who teach rather than preach. Ask thoughtful questions, not to impress but to understand. And when you learn something valuable, share it. That small act might change someone else's entire trajectory, just as someone else once did for you. We live in a world that celebrates hustle, but often forgets the value of help. A world that teaches independence, but sometimes forgets to honor interdependence. But when it comes to money, and especially investing, the strongest position you can take isn't always standing alone. It's being anchored together with others who care, think, grow, and commit. You don't need a crowd. You need a few solid connections. You don't need a guru. You need honest, two-way conversations. You don't need perfection. You need progress, shared, supported, and sustained over time. So if you've been doing this alone, pause. Take a breath, look around, reach out. Because the path to wealth doesn't just require information. It requires integration of ideas, of experience, and of people. And when you stop carrying the myth of the solo investor, you begin to walk forward with strength that multiplies, not just adds. You're not alone, and you never have to be again. Every investor has scars. Some are small, like a stock that underperformed or an opportunity missed. Others feel bigger, heavier losses that shake our confidence, moments we wish we could undo. But what separates those who build wealth from those who walk away in frustration isn't perfection. It's what they do next. Mistakes in investing are not the end of the road. In fact, they're often the beginning of something better if you let them be. Because every wrong turn holds a lesson. Every emotional decision points to something deeper we need to address, maybe a fear we haven't confronted or a belief we haven't examined. And when we're willing to face those lessons with honesty and courage, we don't just recover, we evolve. The most successful investors you've ever heard of, they've failed. They've misjudged timing, overestimated confidence, followed hype, acted too soon, or waited too long. What makes them great isn't that they avoided mistakes. It's that they mined those mistakes for wisdom. They kept showing up, they adjusted, they learned, and they didn't let temporary setbacks define their long-term story. So if you've made mistakes, you're in excellent company. But don't stop there. Learn from them. Write them down. Understand what they cost, not just in dollars but in mindset. Then ask the most important question: what will I do differently next time? Because your financial future isn't built on getting everything right. It's built on getting better over time. Investing with wisdom means seeing the whole picture. It means choosing clarity over complexity, process over perfection and growth over guilt. It means you're not chasing the market, you're building a relationship with it. A mature, steady, resilient relationship rooted in principles, not pressure. You are the leader of your financial life. You don't need to know everything, but you do need to stay engaged. And if you keep learning, especially from the moments that hurt, you'll find that what once felt like a failure becomes the foundation for a future that's stronger, smarter, and fully your own. Let your mistakes become your mentors. Let your journey continue with greater clarity, deeper confidence, and the quiet power of persistence. Your best investing days aren't behind you. They're still ahead if you choose to keep going.